Hello, chart watchers, and welcome to this Tuesday, May 14th, 2019 Market Watchers live show with your hosts, Tom Boley and Erin Swinland. For those of you joining us for the first time today, welcome to the show, and for our regulars, welcome back. Well, the market is trying to bounce back today. You can see the Dow Jones Industrial Average currently up 321 points, the S&P 500 up 35, the NASDAQ up 108, and the Russell 2000 up 19. 10-year Treasury yield bouncing back up above that 2.40% level, still holding above the March low around 2.36%, but also still mired in this downtrend over the past few weeks. Volatility index, this might be the best news of all. We are seeing the volatility index move back down. It's down about 13.5% today. And I did note yesterday when the Dow and S&P 500 were hitting new lows, you can see the volatility index never went back up and hit a new high. So it does appear that some of the nervousness is coming out of the market, and that is a good signal for the bulls. Energy leading to the upside today, up nearly 2%. Technology, financials, industrials, these three aggressive groups had a rough day yesterday, all bouncing back today, which is good. Oil equipment, you can see after having a steady downtrend for about the last 3 or 4 weeks, finally having a nice day to the upside. This group is up about 3%, a little over 3%, doing very well today. One company reporting earnings not being treated so well, Polo Ralph Lauren, huge move down today. You can see losing lows that it had a couple of months ago. So moving to some fresh new lows, not good news there. And it's happening on some very heavy volume. Okay, Erin, it is Tuesday, and I tell you, this market from one day to the next, you don't know what you got.
I know. The volatility is just killing me here. It's just, when it gets so volatile like this, and we talk about it all the time, it's just so hard to avoid risk.
Yeah, and, during the sentiment yesterday, you touched on it where, the volatility index, I know you look at it on the Bollinger Bands, and you'd kind of pierce through to an oversold level on the VIX, and we are getting that move back, lower on the VIX and back higher in the overall market. It just... that's one of the things, unfortunately, when the market gets really nervous, it's hard to predict exactly where the market's going to turn. But when things are getting really nervous and really volatile and there's a lot of fear coming in, we're approaching a key bottom in the market. It's just, if you're off by a day or two, it can be almost devastating, though.
Yes, very depressing.
Yeah.
I don't know.
What was that?
I'm doing okay. I'm just... I know everybody else out there is probably feeling like you and I just sort of treading softly.
Yeah, I get real nervous. I don't like trading when the volatility moves up because, like I said, it's just hard to tell from day to day what you're going to wake up to. I mean, I do find it a good that yesterday when we had that big gap down where we are trading back up above where we opened yesterday. So we're trying to fill that gap. We'll see whether or not we can do it throughout the day. But as we continue to strengthen, one thing I'm going to look for is to see whether that leadership continues to get back into some of those aggressive areas like technology, and financials, and industrials.
Yes, absolutely. That's something to definitely keep an eye on.
Yep. All right. Well, I know you got a workshop coming up, but we got lots of other stuff going. So I'm going to let you get us started here.
All right, let's do it. Upcoming schedule tomorrow, Christopher Brecher is going to be on the show. I'm interested in talking to him. He does say that he will be talking about IPOs, so that could be interesting, of course. Talking technically, our new segment will be on the following day, on Thursday. Friday, Mary Ellen McGonigal will be in to do What's Hot, What's Not with Tom and co-host. All right, today, though, big day, of course. After our technical news and headlines, I'll be doing a moving averages workshop. I'm kind of giving it a 2.0 from the one that I'd done a while back. So hopefully you'll enjoy that. 10 and 10 Boot Barn is going to be our first symbol, and Turning Point will finish the program. All right, Tom, technical news and headlines. Let's start going.
All right, there were no economic reports out today, so let's start with the 10-year Treasury yield. And here is that chart. You can see that we are bouncing off the earlier low today. We had gotten down to 2.40%, not quite as low as we saw yesterday, but we have now reversed. We're up a couple basis points, back to 2.425%. Obviously, it would be good to see that continue to move higher. That means money would be rotating away from the defensive treasuries. But for the moment, over the past several months, we continue to be mired in this downtrend. Some of it may be based on the fact that the bond market is not sure about the economic growth ahead, some of the uncertainties relating to the trade war and so forth. And some of it could just be the fact that the dollar has been pretty strong, keeping commodity prices low. And as a result, inflation expectations are very low and maybe even lower than what the Fed has targeted. So I think that combination is keeping our Treasury yield low. I personally would like to see this move a little higher because it would indicate that we are seeing money rotate away from a more defensive asset class. But at least for now, we are holding that March low, and I would continue to watch that. Earnings reports, things are starting to slow down, but there are still a number of reports. These are just smaller companies, that's all. A number of companies did report last night and this morning, but it's going to be a notable drop in the number of companies reporting over the next few weeks. And you can see here on the list, most of these companies did beat expectations. One exception was Mimecast, which is a software company, MIME. We'll talk about that one in just a bit, but I do want to start with Polo Ralph Lauren because this was a report that I thought was very, very weak. And so as we take a look at this chart, I don't really need to explain what's going on here. I mean, yesterday we had a pretty rough day heading into the earnings report, breaking down to the lowest close the stock had had in more than 3 months. But then today with the news, it fell even further. They did beat on their bottom line, $1.07 versus 93 cents. However, their outlook wasn't great. And when I was looking at this on a relative basis, I remember looking at this at one point yesterday, I wasn't really impressed because heading into the earnings report, we were at a 3-month relative low to the clothing and accessories group. And you can see over here, the clothing and accessories group barely even moved to a relative high in April and had already started rolling over. So not a great group, not a great stock within the group. So we shouldn't be overly surprised when they come out with numbers that were not too impressive. A couple of other stocks, though, that did report and I thought looked pretty good. Here's one, Steris, STE. This is a company that reported very, very nice results. A big beat on their top line, $768 million in revenues. Market only expecting 738.9, so an easy beat on the top line. Bottom line, $1.53 versus $1.44. And then they guided their fiscal year 20 revenues higher. So really a trifecta for the stock. Medical equipment, though, has been rolling over. Look at Steris. It's one of the better stocks within the medical equipment group. So if medical equipment stocks can continue their push off of that relative low in April, then I would think Steris is going to be one of those companies that should benefit. Now, I know seasonally, healthcare does tend to pick up over the summer. So I thought I'd just pull up the Dow Jones U.S. Medical Equipment Index, and let's take a look at that seasonality for just a moment. And if we go back the last 20 years, you can see that May, June, July are okay. As we get deeper into the summer, I think the relative strength actually picks up. And the way you can check that is to put this benchmark S&P 500 in here as a comparison. Now it will tell us how often the medical equipment beats the S&P 500 by calendar month and by how much. And take a look at this right here. May, June, and July tend to be very strong in terms of the medical equipment performance relative to the S&P 500. So knowing that historically money tends to rotate into the group, it also helps to know that you've got a good stock with STE, which just beat guidance or beat estimates and raised guidance. Not yet breaking out, but I think an uptrend remains in play here. And given what the market's just gone through over the past week or two, the fact that this company is up challenging its high for 2019, I think tells you a little bit about its relative strength. So far, so good there. Another one I think that's been picking up steam here is Legg Mason. Legg Mason reported, and you can see breaking out. The stock pulled back yesterday. Of course, everything in the market pulled back yesterday. Came back down to the 20-day moving average on heavy volume, but today came out with its earnings. And this is another one where if we look at it from a relative strength perspective, look at what this stock was doing before it came out with its results. Now, this is relative to the asset managers group, which has not been in a very good group. Asset managers, you can see, continuing to move lower. But if you start to see money rotate into the asset manager group, Legg Mason is likely to perform extremely well. It's breaking out to probably about a 10-month, 11-month high. and doing so in a market that's not been good and in an industry group that has been one of the worst in the market. So I think it's worth keeping this one on your radar. Legg Mason really performing well. They did come up a little short on their revenues, but they beat on their bottom line, and they increased their dividend 18% up to 40 cents a share. So quick math, I'm thinking that it was probably 33 cents before. So they've raised that another 7 cents up to 40 cents a share, and it's breaking out. It's one of the leaders in the group. CYBR. This is CyberArk software in the software space. Now, this stock really struggled after an earlier move to the upside. Looked like it was breaking out. High of 133.49. Prior highs right around $130. So it had a breakout. And now look at that reversal coming in. This has been one of the leaders. So I don't expect that this is going to be a huge, lengthy pullback. But I think a lot of the good news was already built into the stock price. And as a result, with this false breakout, I'd be a little careful in the near term. A lot of tails coming down here around 110, 115. So I'm thinking maybe if it continues to weaken into today's close, we could be looking at maybe a test of that area, 110, 115. But I would then look for a reversing candle if we get that. All right, let's take a look at... I'm going to pull up another one. This one wasn't on the list I gave you on the slide, but Immersion Corp came out. They just met expectations on their revenues, and it's a very small company, by the way. Only did $5 million in revenues in the last quarter. They did beat on their bottom line, and they had a pretty significant raise on their revenues for fiscal year 19. They originally had said 24 to 30 million, so consensus was 27.1 million. But they just announced that they have raised their revenue guides to 36 to 41 million, which is pretty significant. I mean, that is roughly 33 to 50% above the consensus estimates. And the stock, you can see, got an earlier boost to the upside. It actually gapped up quite a bit today, closing yesterday at 922. Today opened at 10.16, so it was up almost $1 on the open, about 10%. Went all the way back down to 8.30, currently at 8.62. I don't like this candle. Like to see how it finishes into the close. But I thought maybe it had already gone through an exhaustion gap. You can see the huge gap down in February. Gap down, rallied back, went back, established just a slightly lower low, and then we've been seeing this rally heading into its earnings report. And the news was mostly positive with a gap up. So I don't know, a lot of volatility with the stock today, but maybe this is one to keep an eye on, especially if you like the potential of higher returns with a really small cap company here. All right, I think I'm just going to pull up one more chart, and this is the equity only put call ratio. I just wanted to bring this up because the last couple of days we have gone up to about that 0.80 level. That's a high level on the equity only put call ratio. You can see even as bearish as we were back in October and November, 0.8 was pretty high. 0.8 to 0.85 was pretty high until we got the extremes when everyone was just throwing, baby out with the bathwater back in the third, fourth week of December. So this reading could be coinciding with a pretty significant bottom here, similar to what I talked about the open with the volatility index. So just keep that in mind. If the market continues to strengthen, we start moving through some moving averages, my guess is maybe we put in a pretty significant bottom. Of course, if we go to new lows, we're going to have to watch these sentiment readings, and all bets would be off at that point. But the market's starting to show some good signs, and I like the fact that we're getting some strength in some of the aggressive sectors again today with this move up. Okay, Erin, upgrades, downgrades, what you got?
All right, not too many. I've been watching that, obviously, that chart too, and it's really oversold, and you can see even a bull market, it's an issue too. So, all right, it means that it's especially oversold. Okay, let's go ahead and move on to the upgrades and downgrades. I'm going to start with the upgrades, of course. Capital One, COF. Jefferies upgraded COF, Capital One, from a hold to a buy, and they raised their target from $95 up to $115, well off the chart here. As you can see, I've got the PMO sell signal. I see a scooter in decline. I see the OBV in decline. But we are hitting a really interesting space here as far as support goes. You can see that little area where it consolidated. And if you use that as support, we pretty much went in there and we're coming back out. Also seems to coincide with a bounce off of that 50-day EMA. So on the upgrade, I think it looks pretty good, but certainly as far as my investing style, it wouldn't go there. Energizer Holdings upgraded today by Citigroup from a neutral to a buy, and they raised their target from $50 up to $54. So they're looking at this area of overhead resistance that goes up against this October low. You know, we've been in a trading zone for so long on Energizer Holdings, and, you know, it's in that area, that very not sexy space in consumer staples. And you can see it's held up here, but it just hasn't done anything off of that December low. Pretty much all of the stock charts we are looking at tend to be moving up and trending higher. Didn't get that from Energizer Holdings. However, if you're going to trade a trading zone, this looks like a pretty good place to do it. The PMO is turning up. It made that bounce off of this low, and it really stretched out even below that low for the past year, that annual low. So I thought that was interesting. Stretched out just enough, probably got a little bit more fear sellers out of the investors out there. Now it's starting to move back up. So I think a move up to that top of this trading zone certainly could happen. So if you're more of a short-term trader and you like to trade these trading ranges, this one might not be a bad choice on the upgrade. Coca-Cola upgraded by Morgan Stanley today from an equal weight to an overweight, and they have moved their target from $52 up to $55. Super breakout today from that declining trend in the short term, coming right up though at overhead resistance at that February top though. So be keeping an eye on that, but it still has room to move higher toward the high for the year at that December top, just above $50. I'm going to look at this just quickly on the weekly chart because I'm kind of curious where we're lining up here. Yeah, so see, that's the overhead resistance we were looking at on that chart, and then you can see also, excuse me, that all-time high that came in at the end of December, which is right here. So we know that this is an all-time high. So this is going to be really difficult overhead resistance for Coke to get through. But of course, if the market continues in a fearful way, this is an area that might do well. All right, let's move to some downgrades. Wolf Research downgraded HP from outperform to peer perform, and they moved their target from $25 down to $21. Again, you got a little nice move off of that December low to the upside, but you're in technology. You know, you would hope that you're going to perform a bit better through the end of February and into May. But it's been pretty much consolidation straight across. Good news, if you're a trading zone trader, it is at the bottom of this trading zone. That's, you know, it held up back here. It was established actually back here at that March low. So there's that possibility. But, you know, you've got a PMO below the zero line. It just had its sell signal. Look at OBV volume just tanking here. So, I mean, it's in a space where you could see the bounce coming up, but not a very pretty chart for HP. And Steve Madden, you were talking about Ralph Lauren. Steve Madden also getting hit and hasn't been doing well for, you know, since that top back here earlier in May in the month. But you can see the PMO sell signal here. We've got tops moving lower on the OBV. Scooter is now hitting a low, challenging the low that we saw in February. You've got the breakdown from this area of support at that March low. I mean, if you want to, we always say don't trade on hope, but if you wanted to hope for a place that it might stop, I think you could get that right there at those tops that we saw back in December, but more than likely, I'd be watching for that move down to the lows that we saw back in October and December. So not looking good for Steve Madden right now. Shopify, much better looking chart than the others, I must say. We're on a nice rising trend. Of course, we hit the top. And now we're starting to pull back, but we're reaching that 20-day EMA. I would say that more than likely, Tom, this would be sort of your setup, getting that test off of that 20-day EMA. The PMO has turned down, it's topping, and it is in overbought territory. It needs to unwind a bit. OBV, the volume is starting to show some deterioration. So I don't know that I would be in just yet, but I would certainly keep it on my list and watch, see if the PMO can get itself a little less overbought and then turn around.
You're reading my mind, Erin.
Yes?
You're reading my mind, because actually I have that on my list to talk about during Turning Point later in the show. That is a point. I am looking at this stock on the 20-day. It's been one of the better performers out there.
Absolutely. I mean, you can see that move. So yeah, I saw this chart and I was like, I got to talk about this one. I know Tom is probably, if you weren't eyeing it, I was thinking you might.
Yep.
All right, so that's it for upgrades and downgrades. There you go, the summary slide. I'll have that up in the Market Watchers Live recap. Whew, okay, catch my breath. We're going to move into moving averages, my workshop for today. And I'm hoping to get a few more visuals here than I've done in the past for some of these that I've had before. So hopefully you'll enjoy this, but it is sort of a reprise of what I did months ago. And I think we all could use that refresher all the time. So I will go on and get started. So, all right, first up, what are we going to cover in today's workshop? Well, I wanted to give you just a quick history of moving averages. And of course, we'll define the three major types that people use. We're going to look at some of the general trading rules if you want to just trade off of moving averages. And we'll look at dual moving averages, which really leads us right into the decision point trend models, which use two moving averages to come up with our signals for each of the three time frames. All right. So really the history of moving averages, they were brought into the stock market after World War II because anti-aircraft gunners found that they used these moving averages in order to sight those enemy planes. And so it was a way for them to get a jump on it a little bit, or kind of, calculate what might be, which is almost what we're doing really with price, right? We're watching the price and hoping that by watching those moving averages, we can see, give us an idea of where price is headed or might be headed. Before I get too far into this, I do want to give Dr. Alexander Elder credit because much of the definitions I'm using in here and the trading rules came from the New Trading for a Living. Highly recommend it. It's a great primer, so something to consider. All right, so according to Dr. Elder, a moving average reflects the consensus of value within its time window. So that's where everybody is, over time, your price is moving the way it's moving. Obviously, you've got the moving average and price moving around that, and that's telling you what the actual value is when you look at a moving average that way. All right, there are three types of moving averages. There's a lot more, but these are the three I was going to cover today. But the ones we use on our charts, simple moving averages, of course, are very popular. Those are, regular average like you learned in school. Exponential moving averages, I prefer. I'll discuss that a little bit later. And then there are weighted moving averages, and there are a lot of averages that fall into this category, the triangular, the geometric, and there's just a bit more of them out there, but typically these are the ones, the simple moving average and the exponential moving averages are the ones that we typically use. So the simple moving averages, just like I said, it's pretty much how you learned it, in school. So you take your period of however many days, the number of components, atom, divide by the number of components. It's pretty straightforward. So there are some advantages. Mainly is it's just really easy to calculate and understand. It's part of the reason I use on balance volume. It's very easy for me to calculate and understand day by day. The disadvantages to simple moving averages is they have this thing called drop-off effect. This is kind of an extreme example, but imagine you have 10 data points, 10 price points, and then you divide by 10, obviously, to get your average. Well, then each data point equally contributes 10% to the average. So if you, for example, got a really large price drop at the, for the day, that's going to skew that average quite a bit. But as that moves down, that data point, that huge decline, and it moves down, eventually it's going to drop off. And now that's going to really change the character of your moving average on the right-hand side where we watch all the time. So that's my reasoning. Part of my reasoning for not using simple moving averages is because with the decision point trend models, we really are trying to concentrate on getting these signals, the buy, sell, and neutral signals. And so we need the weighting to be more on the front side of the data as the back side of the data, I guess. So the more recent side. So let's discuss that exponential moving averages a bit more. I'll show you how you can calculate that right here. So basically you come up with your weight multiplier. You then use that to come up, you weight each of the price points in your whole thing. You weight it using the multiplier, and then that helps you with determining how important it is to your data to make that average. And then there you go. Here is the calculation. It's all in chart school. I don't think there's any reason for me to go over that too closely. So what are the advantages? Like I said, I like it because it's better for trend following, because it puts greater emphasis on the more recent data. And then you don't really have that drop-off effect to the same degree that you might in a simple moving average. So when we talk about the moving averages, which ones do you use? That's a great question, right? I don't know. Do I want really short moving averages that sort of bounce around a lot? Do I want those really smooth, longer term moving averages? Well, here are the pluses and minuses. The short time frame windows they really whipsaw quite a bit. And I see that all the time in our short-term trend models, because we're looking at 5 and 20-day EMA crossovers. So that 5-day EMA is whipping around a lot. So you're going to get a lot of whipsaw and possible signal issues there. Dr. Elder says that look at the length of the cycle that you want to really put the most emphasis on, and then take half of that, and that determines what your moving average might look like. All right, so general trading rules that Dr. Elder uses, these are pretty straightforward, and obviously I think we all kind of use these and just tweak it. But if you're going straight off what you look for with moving averages, you want to see it rising. Obviously, your moving average should be rising. You want to trade from the long side when that's happening. You buy those price dips. We were just showing how that one chart showed the price had come down, touched that 20-day EMA, and then moved itself, boom, right off of that. So that's where you want to start buying. Even, the EMAs are continuing upward, but the price can go down and test it. And then he says to set a stop below the latest minor low. And then you raise your stop, obviously, as prices move higher to protect your investment. So here's what I'm talking about here. So while the EMA is rising, you want to stay in. Price comes down and tests it. That might be a place to add on positions. You come back up here. So here is where he's saying to enter when the EMA starts to rise. And you've got that happening over here as well. And then as the EMA starts to turn, that's when you're supposed to get out. And of course, with an EMA, this is, you may not understand the calculation so well, but with an EMA, if the price closes above the EMA is going to start moving up. And if it closes below it, it's automatically going to start moving down. That's just how they work. So, you're talking about entering on rising EMAs and, those getting out over when they top. It's a pretty simple way to look at it and something to consider. But yes, as soon as price moves below that EMA, okay, the EMA is going to top. So you are kind of trading on the crossovers with the EMAs. But like I said, you should read more in Dr. Elder's book. I just wanted to give you a taste of how some traders use those EMAs to trade. So when the EMA is falling, it's pretty much the opposite as far as where you hit your stop. And I mean, it's just the opposite of what we just went over. So I'm not going to cover that too much. But here you go. The EMA is starting to fall. That's when you get out. EMA starts to turn up. That's when you're supposed to be getting back in, right? So basically, you enter when the EMAs start to fall, and that is going to be when price drops and closes below that EMA. The other rule is if those EMAs are trading sideways, if you're just getting, you're getting what I call braiding. When I use my moving averages, when they just start to cross over each other and move sideways, you have a very directionless market or stock there. And so you don't want to really use the trend following method. It's not going to help you if trading is mostly in a trading range. So pay attention to that. All right, a few other things on moving averages. They can be used to determine your support and resistance areas, which is what we were just talking about as well. I know that we do talk about support being found on moving averages or resistance being there for moving average if price is coming back up to it. We use moving averages for indicators. I especially do with decision point because our trend models are simply crossovers of different moving averages, and then we label them depending on which direction they're going and what side of other EMAs they're on, but I'll talk about that in just a moment. You can also use the Bollinger Bands and construct channels around your moving averages. I'll just go over and show you really quickly what that might look like. So I'm just going to take, I always do this. I lose my mouse. Nope, there it is. Okay. There it is. All right, so I've got a bunch of moving averages on here. Let's just take the, we're going to take all of them off, but the 20. And then we're going to add the Bollinger Band. Oops, here we go. And there's the 20, that's what we're talking about, and we're looking at two ATRs, I guess that's what it is, two sigmas. I have to remember my math. So basically, I took a Bollinger Band that's going around a simple moving average. Well, obviously, that average is not matching up with my 20-day EMA, so I'm going to change that just to make it a little more clear to a simple moving average. Okay. There we go, because see, now you can see that it matches. So you can add the Bollinger Bands to your moving averages and use that as touch points to get in and out of the market, depending on whether they puncture those bands or not. So that's one thing to consider as well. All right, dual moving averages. This is where we look at the crossovers, but Dr. L Elder calls it a value zone, a consensus of value, because you're looking at the long-term, for example, EMA, and then a shorter term EMA. And so that space in between, he's saying, is that consensus of value. We use dual moving averages often for our trend model signals, and other people use crossovers for signals. And here are the trend models. So I just wanted to talk about these because it's a great example of how you can use dual moving averages to study and look for price pivot points. So the short-term trend model for decision point, we use the 5 and 20-day EMA. And as I said, it's based simply on their crossovers, but we look at them in relation to the 50-day EMA, because if the crossover occurs above it, that's a neutral. If the negative crossover occurs below it, then it goes into a short-term sell. So that's why we say in relation to. Intermediate term trend models, same thing, 20-50 EMA, but we use that in relation to the 200-day EMA. So if a 20-50-day negative crossover occurs above, it's a neutral. If it occurs below, then it's a sell. Long-term trend model, all we are looking at are the 50 and 200-day EMA crossovers. All right. Well, we talked about that. So here is the long-term and intermediate-term trend model signals, just to give you a feel for it. There's your 50-day EMA crossing above the 200-day EMA. So that's a long-term trend model buy signal. This is an intermediate-term trend model buy signal, a positive crossover. Basically, anytime I get a positive crossover of my dual moving averages, it's a buy signal. But then there's those neutrals and sells. And like I said, for example, this is a good one. You've got the 20 crossing below the 50 up here, that negative crossover, but it occurs above the 200-day EMA. So that becomes a neutral and not a sell signal. So that's what I mean, crossing above or below. That's how I determine if it is a neutral or a sell. And here are the short-term trend models, those 5 and 20-day EMA crossovers. And again, same idea. You get the negative crossover above the 50-day EMA, then it's a neutral. When they're below those crossovers, like, well, it's not an actual crossover, but if it comes in below the 50-day EMA, then it is a sell signal. All right, so here are some of the takeaways. Like I said, I'm going to look at a few examples of how I use it, and then we'll talk about the poll. But what I want you to really think about when we're talking about moving averages is really very important to understand the differences between a simple moving average and an exponential moving average. And, everybody has their preference. Like I said, I use the EMAs just because I want to put more emphasis on the near-term data points. Because simple moving averages, you do have a drop-off effect can be a problem. And I'm going to show you a chart about that in a moment. And then, of course, using dual moving averages is a great way to look for support and resistance, find that value zone as the consensus of value, as Dr. Elder had talked about. So yes, be sure and pick up this book or thumb through it. This is where I got my information as far as the trading rules and that sort of thing. So if you wanted to learn more about that, I would recommend you go check out his book there. But let's look at just a few ways we can use our moving averages to our advantage. All right, so here we had the Bollinger Band. Remember, I had put around that 20-day EMA. Let's go ahead. I prepared a chart that shows you, and I'm going to show you down here what I'm doing. It has the 200-day exponential, the 200-day simple moving average, and then the exponential and simple of the 50-day EMA. The thick ones are the ones I use. Those are the EMAs in the chart above. So I just wanted to let you look at this and see what the differences are and why drop-off effect is something that you may want to consider. Look at how, first of all, so we have these 50 and 200-day EMAs. The 200-day EMA, that's your simple day. simple moving average. See how they're very close together here at the end. But where do they really move apart? They move apart when we start seeing these really big moves in one direction or another. And that's really, to me, where I like to use these moving averages. So this is a little cleaner over here. But as you can see, we had this top back here, and we had a huge gap down. The moving averages were almost equal at that point. But then when it started to, it popped up, but then it started to come back down. Notice that the EMA started to react faster. It started to move lower faster than the other, the simple moving average, the 50-day. Now, in the 200-day example, they do tend to travel very closely because they are long-term. But again, you can start seeing the drop-off effect when you end up losing something large like this on the back end. It's going to change your simple moving average by a bit more. I also decided to look at this one anyway as the what the trend model would have done. If we used the simple moving averages for our long-term trend model, we wouldn't have gotten that crossover until almost mid-March, whereas we got it a bit earlier, I would say, at the end of April. So we knew we were moving into a bull market configuration. It came after some consolidation, obvious that deep decline. So I got a crossover a bit earlier here for the long term than I did back here. And so it's, again, a matter of preference. I recommend you put these on a chart and maybe go back and look at the different crossovers or how they react. I have another one here too. And I think I did this one. Yeah. This is the one I believe I was going to look at. Was it this one or? Yeah, I think it was this one. All right, so on this one, and we'll come down. Again, the thick ones are my EMAs that I always use, and then the skinny lines are your simple moving averages. So in this case, where did we get the buy signals for the EMAs versus the simple moving averages? Well, here you got the buy signal, the 20-day EMA crossed back above the 50-day EMA, and that's when the decision point trend model would have kicked in that buy signal. But notice we didn't get it until later on the simple moving averages. It just took longer for it to get back up there because it was affected somehow by the data it had probably on the back end, where we started to really see some margin being put between the 20 and the 50-day simple moving averages. So again, really interesting to see the effect of an EMA versus a simple moving average. They do tend to travel very similarly, but there are times when they do not. And I think that it gives you some extra information that you might find helpful or interesting. So let's go ahead. I am going to call up gold. Let's look at gold right now, because I am watching these moving averages fairly closely right now. So these are my EMAs. And again, so long-term trend model, how do I get my signals? 50 and 200-day EMA crossovers. So back here in the beginning of January, we got the moving average crossover in the long term. So that gave us a long-term trend model buy signal. And also put gold in a bullish configuration, in a bull market configuration. We kind of say that when you get that crossover to the upside, you're now in a bull market as far as that stock or index or whatever you're looking at. You're now in a long-term buy. You're in a long-term bullish situation. And so that's when you want to start considering getting in or holding, is when you have that 50 above the 200-day EMA. It's obviously telling you have some strength in the longer term. The other crossover, notice we got the buy signal back here. This is what I call braiding flat EMAs. So despite getting that signal, if you really had followed Dr. Elder's advice, you probably wouldn't have gotten in until you really started to see some margin being put between these EMAs. So that's another thing to think about with the EMAs. And right now you can see I just got a short-term trend model buy signal on gold. I've been waiting for that breakout, and we did get that yesterday. So that pretty much concludes my my presentation on moving averages, and I'll just bring you back again so that you can see not only that is the book, but again, remember that these averages are different. They're not created equal, and you have to determine what you really want on your charts to determine, what is your style of trading. Do you want to put more emphasis on the near-term data, or do you want very equal across the board? And I'll say, I know Mary Ellen McGonigal also, I know she uses the 200-day simple moving average. And I was like, why do you choose to use the simple moving averages? And she said, well, especially with the 200-day simple moving average, I know a lot of money managers out there. I know a lot of, analysts use that particular moving average consistently. And so I want to have that same understanding of a chart. So she chooses to have the simple moving average because she knows that across the board, a lot of her colleagues use it. So for me, I'm all about EMAs because that's what Decision Point uses for our trend models. So to each his own. All right, Tom, that pretty much wraps it up. Maybe we should go ahead and take a look at the poll because I did ask about moving averages and which kinds you tend to use. All right. Wow, I'm surprised we had the mix like you do because I know I'm sure you get questioned regularly. Why do you have an EMA and an SMA?
Yeah, I get that question a lot, and mostly it's just because I'm weird.
Well, we already knew that, but...
Yeah, for me, I can understand why you use the EMAs because you're looking for the crossovers. And so I think using one as an SMA, one as an EMA, I don't know, kind of apples and oranges kind of a thing. And I do think your EMAs, as you showed on the one chart, by using the crossovers, the EMAs are going to cross, I would think, quicker. I haven't really thought about it, but I would think they would cross quicker and give you signals quicker than the SMAs. So that makes sense to me. Mm-hmm. But for me, the reason I use the SMAs for the longer term is it just doesn't make any common sense for me to take a 200-day moving average, which is, obviously we're taking a lot of data and it's over a long period of time. So it's a long-term moving average. And so applying more weight to the more recent data to me doesn't make any sense. I'd rather take like a 20-day EMA because that's my short-term, really quick moving average that I want to follow. And I'd prefer to get that signal quicker than the 20-day SMA. But for a 200-day or even a 50-day for me, I like the SMA just because, again, I don't want to look at the more recent data in a long-term moving average. Long-term is the long-term. And so I just kind of keep it that way. So I never followed anybody in particular. There was no rhyme or reason to it. It's just kind of what made sense to me is to have the exponential with the shorter term moving averages and the simple with the longer term. But that's why I do.
No, it makes complete sense. I mean, the more data you have, the less important, I guess, that drop-off effect will have because you have so many other data points. It would have to be an extraordinarily different, drop or rise that would really affect it by too much.
Yeah, and I think that one of the takeaways too is that you're going to have a lot of technical traders and, maybe some that don't pay nearly as much attention to technical, information, but they may still use like the moving averages. And so you're going to have a lot of folks looking at both the SMAs and the EMAs. And I just think it comes down to each individual style and strategy and what seems to work best for you. I don't think there's one right way or one wrong way to do it. I think it's whatever works.
Oh, absolutely. Totally agree. It depends on your objective. So anyway, boy, that went fast.
Yeah, good job, though. Good job. It's always good to go back and do some refreshers. I know a lot of folks that are watching the show probably do use these different moving averages and may wonder why we use different ones. And then there may be some others out there who may be new to technical analysis. And I think that was a really good educational segment for them. So good job, Erin.
Excellent. Thank you so very much. But it is time to move into the 10 and 10. Everybody, if you haven't gotten your requests in, I'm sorry, it's a little too late, but go ahead and vote, and the most popular will be our second symbol. So let's go ahead and get started with Boot Barn.
All right. I'm going to give this one the boot. I'm just not, well, let me change that a little bit. Let's see whether or not we can hold by the end of the week above this 20-week moving average, the 20-week EMA. As you can see, the last uptrend, notice that rising 20-week EMA provided great support throughout 2018 and on the rise. And so once we broke back above that 20-week EMA in early 2019, we haven't had a break below until this week. Now, if we can finish strong this week and the market rebounds and Boot has a really nice finish to the week and can get back up above, say, that 27.32 by Friday, then we will have a nice hammer right on the 20-day. We'll have tested and even gone a little bit below the 2019 price support that we enjoyed back in March. So there could be some real positives by the end of the week. But currently, I'm not liking the look of this, and especially if we were to go back down a little bit by the end of the week, if the market rolls over, or let's just say Boot were to roll over and finish down below the low in March, to me, it would just start to create a little bit more nervousness for me in terms of the technical strength here. So I'm kind of cautious, as I am with a lot of stocks right now. I'm hoping that I'm right, that the volatility index spiked and that set a bottom, and that the put-call ratio spiked and that helped to set a bottom in the market. And if that's the case, we're probably going to see a lot of stocks that had false breakdowns or tests of support that then turn and go higher. So I'm hoping that Boot, falls into that camp, but let's see how we are by Friday, where we stand.
All right. The most popular in the chat room right now is CVS.
All right, drug retail. I'm going to pull this up on a relative chart so you can get a real good sense of the problem here. Here is the big problem. Drug retail relative to the S&P 500 has literally just kind of fallen off a cliff over the last 5 or 6 months. Since early December, late November, early December, you can see we had a double top in play. And then once we started rolling over, it has been a big, big downhill move for drug retail, not just on an absolute basis, but on a relative basis, meaning that money is just not there. Money is not rotating into this group. It's rotating out of the group. And anytime that's happening, unless you have the 1 or 2 stocks that are just the absolute best in the group, you're probably going to lose money, or at least you're going to underperform the S&P 500. And so this is what I would annotate. That right there is a problem to me. If you look at CVS relative to the S&P, it's been horrible. It has been outperforming the last couple of months, the drug retailers, but the drug retailers have been horrendous in a pretty good market until just the last week or two. So, volume trends are weak. I just see a lot of negativity here on this chart. I'm going to throw in there a couple of levels to watch. I think right around that 58 area, we need to watch. And then we've got a triple bottom coming in at about $51.50, $51, something like that. I just think we're in this trading range off of a downtrend. This is a bear flag. I suspect that we would break to the downside. Maybe if the bull market resumes, that'll help keep this one afloat a little bit. But I'm just not a fan given these relative strength readings down here. So I'm going to pass on CVS.
All righty. Let's see. The next one is Axon Enterprise, AAXN.
Oh, wow. I was just looking at this one. It's in the defense industry. Great looking stock, I think. I like the move back up. I loved this gap down yesterday and the recovery back quickly above the 20-day moving average. Defense stocks, this is actually one of my favorite areas in the market right now. And you can see that since early April, not only are we rising rapidly relative to the S&P, but we have now broken out to about a 6-month relative high. So defense stocks are getting the lion's share of the money here right now in terms of comparing to the benchmark S&P 500. And AAXN is outperforming the S&P wildly. It's outperforming the defense group So you've got a group that's getting more than its fair share of the money out there, and AAXN has been one of the leaders. So putting all that together, I would annotate this and just, anytime I see a chart that is doing this, really just these last few months more than anything, but going up from left to right across the chart, that is what you want to see right there. So as long as that continues, I think AAXN is a great play in the defense stocks. Maybe an area to watch to the downside would be the breakout level, and then this pullback right in here. So I'm going to say maybe at about $58.50 to $60. I think as long as we hold that level, we remain in an uptrend. But I'd really like to keep above that 20-day moving average. We've been there above it since gapping up on good volume back in March. So I'd like to see it continue to stay above that level.
All righty. How about it's not our only financial request, but how about eHealth, EHTH?
Yeah, EHTH, I think is just consolidating. This was a great performer in 2018 and even into early 2019, as you can see. I actually did a brief little snippet for Earnings Beats free newsletter, and this was a stock that I covered on Monday yesterday. And the point that I was making is that this was a leader, a relative leader within the life insurance space. Now here you can see life insurance going down, but look at the relative strength of eHealth going up. Now this was before we even had a big move in life insurance to the upside. So the stock was going up, even though life insurance was getting hit very hard. So the relative strength was pretty easy to see. And it outperformed the S&P, even though it was in a group that was badly lagging the S&P. So this is telling you you've got a really good stock in a bad group. Well, when life insurance started to turn higher back in, this was late December, and we started to move up, and you can see on a relative basis, life insurance actually bottomed in the second week of December and started moving up. When this happened, and I could draw let's draw a vertical line in here, right here. So when that happened, take a look at what happened to the stock. It absolutely exploded off of this little cup handle and breakout. When money began rotating back into life insurance on a relative basis, then we started seeing even more movement to the upside on eHealth. Stock went from $35 at the beginning of the year, maybe $37, up to $65 by the beginning of February. So these are the types of attributes that I would be looking for. So even if I didn't want to trade EHTH back in 2018 because the group was weak, I would still want to be monitoring it, because if all of a sudden you start to see the group like this, life insurance, getting a push to the upside, that can be the catalyst to really send a top performer a lot higher. So I think the stock continues to look good. I think the problem with it right now is just that it's run so much, it's simply consolidating. So I'm going to say, and it's a wide range, but I'm going to say $50 to $75 roughly is where we're consolidating. If for some reason EHTH were to drift back down into the 50s, I think your reward to risk starts to get really good there.
All right. Let's see. Next one, Williams-Sonoma, WSM.
All right, Williams-Sonoma, what do we got? Not good. Rolling over, moving to multi-month lows. Specialty retail actually was hitting highs back in April, late April, and almost again in early May. And look at what was happening to Williams-Sonoma, starting to roll over. So without even looking at the relative strength, I know it's weak. And check this out. I mean, we literally just went down to a 52-week low relative to its peers. So this is the opposite of what we were just looking at with EHTH. This is one of the worst performers within a group. And if the group starts to break down, I don't want any part of a stock like this. Even if the stock's going, or the group's going higher, I don't want a part of a stock like this, because I want to get leaders. I want to get the stocks that are actually the outperformers. So this right here would keep me out of the stock. I just don't want to be in a stock that is one of the worst stocks within a particular group. And so once it starts to break down and it's not a good performer, folks are going to start selling it. They're not going to want to hold on to it. If you're looking at other specialty retailers going higher and Williams-Sonoma is going lower, that is going to get pretty frustrating quite quickly. And so I think that's what's going on. I think that's why we're seeing more selling and such relative weakness. So not a fan of WSM here.
All righty. Next one up is CyberArk, CYBR.
Yeah, I mentioned this one earlier with the earnings, but the false breakout there with heavy volume. We are off of the earlier low now, back up to 122.39. This is a nice stock, really good relative performer in software, which has been one of the best areas of the market. So when you look at this long-term chart from left to right, this is the kind of stock you want to be in. Now, I don't like holding into earnings. Had a good reaction to the earnings, but that false breakout tells me you want to be careful here. So I think until you get a close above that 130 area, 130, 131, I think we could be consolidating. I mentioned earlier a couple of levels I'd watch the downside. I think when you get into these lows that we saw back in March and April, 110, 112, this one maybe 108 or so, I think that's an area that if we were to get back down there, that's where I would expect buyers to come back in, because we did have some pretty good volume on a couple of these moves where we went down into this range. That's telling me that there's some pretty good demand in that area. So if we do continue to weaken and we say close below that 50-day moving average, I think if we got back down to the 110, 112 area, CyberArk would be an interesting play.
All righty, let's see. Next one up, pharmaceuticals, Bristol Myers, BMY.
Okay, again, relative strength is going to keep me completely out of the stock. There are others out there, Merck, Eli, some others that are, I think, much better in terms of relative performance. Maybe I haven't looked at dividends. Maybe this is a better dividend player or payer. But I just think when you're looking at a move like this to the downside, you've already got a double bottom. If that's broken, you really want to be careful. A close below 44 on heavy volume probably signals another leg to the downside. But this is the real issue for me. It's again the relative strength. I want to be in stocks that are leaders, not laggards. So I'll pass on BMY.
Okay. How about Mercado Libre, MELI?
Yeah, MELI is on my strong earnings chart list. Another huge move up. Look how quickly when the market rebounds, this stock's up 3.5% today. And when you look down, it's a relative winner. These, from my experience in the market, when you get relative strength, stocks that are showing great relative strength, when the market sells off, they tend to hold up better. Look at this one above its 20-day moving average, holding on to price support. And then when the market begins to rebound, they start to exert their leadership again. So I think MELI is one of the best stocks in the market. I continue to like it. I would trade it if it hits a key support level. I think that rising 20-day moving average is certainly one level to watch as we go forward. I think this is a great performer. Look at all the nice volume bars on these huge hollow candles. That's telling me there is a lot of demand for the stock. So pullbacks, I think, are viable on this one.
Mm-hmm. All right. Next one, Steelcase. It's a furnishings company, SCS.
Yeah, this one sold off on real heavy volume from just under this 18 level. Came all the way back up, got there again, not really selling on heavy volume, but we couldn't get through that overhead supply and get through resistance. So I think that's what I would be looking at here. Now, this is a stock. The group, by the way, has not been a very good performing group relative to the S&P 500. So keep that in mind. That means to me that if we have a technical breakdown, I'm in a part of the market that is not performing well, I would be out of the stock. So I think these lows set the last 2 days are really important to hold. And to the upside, I'd like to see not only a move back up to test this area at 1785, 1790, but I want to see a breakout, and I'd like to see some volume coming in. For now, I'd like other areas better.
All righty. Let's see. Our final one, Zynex, CYXI.
Okay, wow. Big winner. Only thing I would say here, lots of liquidity issues. Up until May, this stock traded below 100,000 shares most of the time. And when you go back into October, November, December. I mean, it looks to me like maybe we were doing 10,000 shares a day. So I have some issues. There's obviously a lot of folks trading the stock right now. But even with all that interest, the biggest volume day was 500,000 shares. And we're talking about at the time a $6 stock. 500,000 times 6 is $3 million. So $3 million controlled all the trading in this stock on its heaviest volume day ever, or at least in the last year. That tells me that this is a stock I don't want any part of, just from a liquidity standpoint. Now, forgetting about liquidity, then yeah, you got a great leader here. Obviously, I mean, the stock's been awesome. I would suspect that you're going to have some support when you get back into this gap support area. If it gets back there, I would be looking at maybe 590 to 620 as a good area. You can see this one long tail. We came down from 680 down to about $6, and quickly the buyers came back in. You've also got that rising 20-day moving average there as well. So technically, I think this is a good-looking chart, but from a liquidity perspective, I would not be in it.
All right. There we go. That is the 10 and 10. And here you are with the symbols that we just went over. I will have these all up in the Market Watchers Live chart list, so you can go grab these charts and put them in your own chart list. Just go to the Articles tab, click on the Market Watchers Live blog, and the link to that live chart list is right there at the top. All right. Well, before we get into our final market update, I would like to share with you something that has been going on here and we've talked about briefly. But right now, we did extend our spring special for StockCharts.com. If you buy a full year subscription, you will get two free months, as well as you get to check out that StockCharts advanced charting platform that we've put together. The special does end on Monday, so I just wanted to let you all know, if you renew, you'll get those 2 months, and if you're brand new, you can get a trial and then sign up and get the 2 free months. All right, let's go ahead and see what the market is doing. Certainly a lot better today. All right. So there you go. We're on a positive move right now. The Dow Jones is up over 300 points currently. S&P 500 up over 35 points. And that does translate in moves over 1.22% for the Dow. And NASDAQ right now is up 1.5% right now. So it hit, though, I'm looking at least at the NASDAQ in particular, we hit this area, we gapped down yesterday to open, and we're just now hitting that area of resistance. So it'll be interesting if it can get through it. I would say, based on what we're seeing on the other large cap indexes, that we should see it move back above that. So we could be looking at even higher prices today. The Russell 2000 looking pretty good here on a steady rise. It is currently up 1.32%. TSX, Canadian markets, are also rising nicely. Their rise started actually at the low yesterday. So that's been a nice run to the upside. As you can see, the Treasury yields are a little bit higher today, reading 2.423%. The VIX is starting to finally fall. It is under 18, reading 1781, which is still a little on the high side. UUP gap up, moving mostly sideways. GLD gold is down right now on the day, 32 cents for GLD at 122.35. USO big gap up and now consolidating sideways. TLT continuing the declining trend that started at the top yesterday, and it is continuing lower, but it does look like it may have found some support at that 125.25 level where the gap happened yesterday on the open. All right, next up, the sector summary really quickly here. Technology leading the way today, up almost 2%. Energy and financials close behind. Our losers for the day, utilities, which was the only positive sector over the last few days, is now the only negative, down almost 0.5% right now. And then I'm going to show you one more chart, and then I'll pass it to you, Tom. But I was looking at this chart today, and I kind of wish I'd looked at it a little more closely last night. We definitely saw climactic readings on breadth. The net AD, we hit the levels we haven't really seen since the bear market back here, started and was at the end before we hit the low. And typically you start getting these really, really spiky climactic readings. And that's when you start looking for the market bottoms. Yesterday we had that penetration and close below that lower Bollinger Band. And that was a good signal that came along with these really climactic negative readings that we were looking at a possible selling exhaustion. So now I'm going to be interested to see what happens with those readings today. If we get some spikes to the positive side to tell us that we might be looking at a buying initiation. And that's all I have, Tom. Back to you.
All right. I'm just going to pull up an hourly chart here on the S&P 500. I've got two sets of channel lines. The red dotted channel line was one that I think I had showed last week on the show. I definitely had it in my blog last week, I know, where I was taking these tops and also connected these bottoms and had this really sharp decline that was all within this channel to the downside. And then on Friday, when we got that nice rally at the end of the day, we actually broke through that channel, and I was starting to turn a little bit more bullish. And then, of course, Monday came, and back down we went with the futures tumbling 500-600 points on the Dow, and you can see 40 points on the S&P 500. And when I went back, and I'm going to get rid of the dotted lines because that's just a little bit annoying now. But if I get rid of those, then I think what you can see here is a chart that has multiple tests along the downside here. And I'll go ahead and get out of the annotation mode. But you can see there's 4 different tests, maybe 5 along here connecting these lows. And all I did is I clicked on this line and I dragged it to the other side. And when I put it on the top, it literally came right down to where we closed on Friday and intersected. So I'm now, instead of looking at that earlier, more steep channel, I'm looking at one that's a little less steep and has multiple tests on both sides. And we'll see whether or not we can continue this move into today's close. But if we get back up, test this channel line, and then tomorrow morning we get more news, negative news out of China or here in the U.S., and we start to roll back over again, just at least keep in mind that we do have this down channel in play. Now, because the volatility index has come down considerably from where it was, I believe that the bottom is in and that we're going to eventually make this breakout. But if we start to roll back over and that VIX shoots back to the upside again, I think you at least need to be aware of the possibility that we have not reached a bottom. I believe we have, but you've got to be open to the other side as well. Okay, we're going to get into the last segment today, which is Turning Point. And what I've done here for Turning Point, I've done a couple of things, actually. I went through and went through a number of the predefined scans on StockCharts, coming up with a number of individual stocks. And then I ran my own scan on the small cap 600. And the reason I did that on the small cap 600, if I go in here and I show you the seasonality, and I'm going to bring up the Russell 2000, and I want to compare the Russell 2000 to the S&P 500 and drag this back the last 20 years. And you can see that over the next 2 months, May is a little bit, the Russell 2000 historically does pretty well against the S&P 500 in May. In June, though, it's its best relative month. So small caps, you can see, have outperformed the S&P 500 84% of Junes since, this century, essentially. So obviously not this year, but over the last 20 years. So over the last 19 years, that's probably 15 of the last 19 years, the Russell 2000 has outperformed the S&P 500. So 84%, that's not a certainty. It's not a guarantee, but it's telling us that there are some pretty significant probabilities that small caps we want to be considering. When you look at that average outperformance, that is 1.6% on average that the Russell 2000 has outperformed the S&P 500 over the last 19 Junes. Average. So if we're flat one year, it means the next year it outperforms by 3.2%. This is a pretty significant number, 1.6% outperformance in 1 month. So that was the reason behind going into the S&P 600, which is the small cap index, and looking for some stocks maybe that I could feature on Turning Point. Okay, so first, before we get into the small caps, let me go through some individual stocks that I found in some other predefined scans. This one, Alta, I think is pretty clear. We had that huge gap up back in March. Earlier today, we went down below that on an intraday basis, and look at this nice hammer printing. I think we're clearly at a turning point on Alta. I like the reward to risk on this stock anywhere down around that 330 level. CLDR. This is Cloudera. I think it's pretty obvious looking at this chart, and I'm going to stretch it out a little bit. Let's go out a year. But that $10 level, I think, is pretty clear. I'm not going to annotate here just for the sake of saving some time. But I think you can see $10 was the low back in December. That's where we've gone again now. The volume trends are weak. I'm not saying that, hey, this is a double bottom. We're going shooting back to the upside. We got a lot of work to do. But this is an area where I would expect to bounce, and we seem to be getting that. This is a turning point on CLDR. Tapestry, TPR. I believe this could be a big reversal here on Tapestry. Huge gap up with its earnings just a few days ago. Stock was under 31, gapped up to 36, came all the way back down, and today, this morning, went a little bit below that April low and is now currently trying to print a hammer. I think this is also a very bullish chart. Annotating there, I think you can see that is the level of support. I think it needed to hold. The fact that we gapped up here testing this overhead resistance, went all the way back down. I like the reward to risk from this level. Next up, Nordstrom's, JWN. And this one I'm going to pull up from a weekly chart. The daily chart, you can see that hammer. On a weekly chart, this stock has been just bludgeoned over the past 6-7 months. It's gone from $66 or $67 a share all the way down into the mid-30s, trying to reverse. Look at these lows back in 2017, right at about $36, $37. This is an area where I think JWN needs to bounce. I would continue to respect that declining 20-week moving average. We have not been able to get above it, but if we have a quick move, get back up into the low 40s, I wouldn't be surprised off of this support level for a rally in Nordstrom. Next up, Shop. And this is the one I was talking about early. Erin mentioned it, coming back down, testing that 20-day. Anytime I get a stock that's got this kind of volume, this kind of movement to the upside, and on a relative chart showing this kind of leadership versus an already strong software group, when you get technical opportunities to buy, I think it's time to jump in. Shopify, right here on the 20-day moving average. I do own this one. At least I think I own it because I had an order in and I believe it went below my order. But anytime you get a 20-day test, I think on a stock that's this strong with this kind of volume, I think is a great opportunity. So Shopify, I think, is at a critical turning point. AMD, I mentioned this one on the show yesterday. But AMD, I think that 26 level was big. I was talking about 26, 27 being a key support level. Also mentioning that while semiconductors have been struggling for the past 2 or 3 weeks, AMD on a relative basis has actually been moving higher and is on the verge of about a 7-month relative breakout versus the semis. So what does that mean? It means that when we start to get a lift in semis, I would expect AMD to lead. And so we're getting a little bit of a bounce today in the semis, and that's exactly what we're doing. We're seeing some more leadership in AMD. All right, Bank of America. Now, I'm bringing this one up not so much because of the price. You know, when you look at it, you say, well, there's no real major level. I guess you could go across here and say 28. served as pretty good support on multiple occasions. But what I'm most interested in here from a turning point is a relative turning point. And so I'm going to annotate Bank of America relative to its banking peers and look at where it just turned off of. So far in 2019, we have had great relative support at this level, and we just hit it again. So this is where I would expect to see the Bank of America outperform the banking index. Banks started to turn back to the upside, and you can see already getting a little bit of relative strength from Bank of America. Let's see what happens if it gets back up closer to that 29.5 area. But at least in the short term, it's doing what I would expect it to do from a relative strength perspective. Last, actually two more real quick here on these, then we'll get into some small cap stocks. First one is AT&T. Have not been a fan of this stock for quite some time, but after gapping down on big volume back in April, notice after the gap down at about 31.10 or so, we moved back up to about 31.55, 31.60, and we failed. So I think 31.10 to 31.60 is a key resistance area. Earlier today, we got up to 31.38, and it's starting to back off of it. I think this is a turning point potentially for AT&T. Facebook, this could be a bullish turning point. 50-day moving average and gap support that was tested yesterday. We had gapped up here in April with its earnings from 182 or 3 up to about 197. Worked our way all the way back down, given all the China and U.S. trade news. Stock came back down to the 50-day, has not been below the 50-day since back in early January. It's a nice reversing candle right now. Looks a little bit like a long-legged doji, which can be a good sign for a reversal after a downtrend. So I think Facebook is at a turning point today as well. All right, small cap stocks. What I did is I ran a scan, and I looked at the S&P S&P 600 small cap index, which just quickly to show you how you can do this. It is so easy. Go down here into your scans, new scan. I always like to increase, that's the default volume, but I'm going to change it to 200,000. Let's see, indexes. S&P small cap 600, add it. And then what I ended up doing is I said, okay, give me the ones that have a scooter above 50. And then I said, give me the ones that have an RSI above 40 and an RSI below 45. So what I'm looking for here are stocks that have scooters over 50, so top half of the small cap universe, but the RSI has pulled back into the 40 to 45 range. So I checked my syntax, which is good to go. I run the scan, and there was like 18 or 19 stocks out. It's 16 now. But when I ran it, there was like 18, I think. So off of that list, that's where I got these stocks I want to go over right now. It would help if I type them in correctly. All right, XPER. Now, here's a stock that came down with the overall market, rallying really nicely today, though, back up almost 3%. And it's in the semi space, but look at the relative strength holding up. Talked about this with AMD. Here's a small cap stock that you might want to consider in the semi space. And what I would maybe take a look at here is some of these recent price lows. So the March low, and then more recently here at the end of March. So I think this 22-23 level is fairly significant. We've had multiple tests here, and we've held. We just did it again yesterday and bounced off of it. So I think XPER is one to definitely consider. We could be at a turning point. I'm going to go through some of these others very quickly because we are running out of time. GTLS. This is Chart Industries, and this is in the energy space. Energy has been a very weak relative performer, but this stock has been a very strong relative performer in its group. That's why these recent lows are so important. I don't want to see this stock break below. I'm going to call it 84 on a closing basis. So watch it closely. It's at a turning point, possible turning point. IRDM, this is Iridium Communications. Another stock that when you look at the wireless communication space, it's been one of the leaders. The overall group has been down, but it looks like maybe it's starting to turn back to the upside. And we've already set a low at 25. We broke out from 24. I think 24, 25 is a really big level on IRDM. BRC, this is Brady Corp. I'm going to pull this up on a relative basis, and I'm going to annotate this quickly. And if I go down here and connect, well, I don't know, something like that. Actually, no, let's get rid of that. Let's do it this way. Connect these lows right here. So you got a couple lows there. I would be watching this to the downside because you do have a trend line here that I would be watching. If I drag this trend line up, you can see I got a pretty nice little channel that I've been in because that slope of that line also connects the tops. So keep that one in mind. I think as we pull back, this is the lowest level we've been in a while, but I think down to about 46.5 still would not be a bad spot for Brady. And then the last, I'm going to try and squeeze two in real quick. First, Fabrinet. I think this is an area with the 50-day moving average pullback. I think this is one to keep an eye on. It has been a leader within its group, consistently moving higher. So recent lows off this big selling brought the stock down just below 56. We almost tested that again today. I think this is a level where we're looking for a potential turning point. And my last stock is Triumph Group. TGI gap support. We've already tested it once. We tested it again yesterday. Volume trends here have been extremely strong, and this is a stock that's been performing very well relative to the aerospace group. So I like the stock, and I think you're at a very critical turning point on this stock as well. So here are the stocks I looked at, and this is your summary. Went through a bunch of them. Yeah, these are ones I think could be at turning points. And that's really, Erin, when I look at the market, I look at these candlesticks. I look at prior support. I try to get relative strength and try and marry it all together to find areas where we can get some high reward to low risk trades. If they go against you, they don't go against you much. But if they turn out to be right, you can make a pretty good amount of money.
Absolutely. I think you teach everybody on the show very well how to use all of those in your analysis and what you are looking at and how to read what's on a chart. So although our styles are slightly different, there's a lot of things that are the same as well.
Yeah, well, one thing I think that is the same across almost everybody that comes on our show is the relative strength. I mean, I think that's a really, really important part of trading that a lot of folks that just get into individual stocks pay no attention to, and I think it's a big mistake.
Yeah, I've learned a lot about how to use that more so even on the show. I mean, gosh, Tom, we've been doing this almost 2 years now, I think.
In a long time.
Yes.
And all of these tools and things that we talk about, you get as a member, as a subscriber here at StockCharts. So we did extend that special for an extra week. Take advantage of it. You have until Monday to extend and get some free months added onto your service. Okay, I want to thank all of you for being with us today. Please remember to complete the survey as you exit. I'm sure Erin would love to hear what you thought of her moving average workshop. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody. We'll see whether or not the market can continue its ways to the upside, and we'll be back here tomorrow. Happy trading.